Hi, everybody. This is Adam Stern, CEO of Strat SFR. I'm excited today because I'm speaking to a good friend and colleague of mine, Brad Hunter from Hunter Housing Economics. So if anyone wants to know about the build for rent trend, how it developed from the very beginning to now and where it's going in the future, this video is all about the fundamentals of the economics that are driving the trend, how builders and developers are capitalizing on it, and how capital is flowing into the space. Brad did a really cool and interesting PowerPoint that outlines a bunch of different elements of build for rent. Brad runs this firm, Hunter Housing Economics, which is a very similar animal to John Bird's Consulting, with some pretty major differences. So I wanted to get him on just to introduce himself. Brad, I appreciate you being with me this morning.
Good to be on with you.
Strat SFR, of course, is a SFR portfolio and build for rent brokerage, looking for projects for our institutional clients and our sellers who are builders and lot owners to find access and exits to those institutional buyers. Great. So for the benefit of our audience, just a little bit about Hunter Housing Economics and kind of what you guys do and what makes you different than some other firms that are out there doing similar things.
Sure, absolutely. So Hunter Housing Economics is a boutique firm, small, 6 employees. We do studies on built for rent, single family of all different types, all the different product types. We've done about 25 built for rent studies on specific sites so far this year. And what makes us different is we focus very heavily on just the built for rent side of the real estate business. And then also, when we do a market study, the guy sitting right here, 35 years of experience, is the one that actually is writing the conclusions and will look your investors in the eye and tell them, here's what the rents can be, here's what the absorptions can be. So that's pretty much it.
Awesome, Brad. So I've got your slideshow up in front of me. You start off the slideshow talking about the trajectory of build for rent, and you kind of go through where it is today in 2021, and then you make a prediction about where it's going in 2022 and beyond, all the way up to 2025. Can you just kind of give us an overview of how you came to kind of develop this slide and what you're really talking about here?
Yeah, sure, absolutely. And I've revised my forecasts higher. The model is predicting a total of 102,000 built for rent starts for this year. Think about it this way: single family housing starts are going to go up in 2021 compared to 2020 by about 136,000. That's the increase, big increase. And 50 to 60% of that increase, I think, is being driven by BFR. That gets you 82,000 conventional single family detached homes built for rent. Add to that another 18,000 that are horizontal multifamily type that are going to get lumped into the multifamily starts. 18,000 out of the 432,000 multifamily starts I'm expecting this year, which is 20 to 25% of the increase in multifamily. Then add in a couple of thousand in the category of the 2 to 4 unit, which is townhomes, quads, duplexes. That gets you to 102,000. And that's still going to be well below demand.
Now
nationwide.
You said, Brad, you revised this. You revised your numbers. Was it revised for this year, or did you revise your projections for the coming years? We all know that build for rent got a big boost, during even now after COVID. Did those numbers change dramatically from, like, say, the beginning of this year?
Yeah, it's higher for this year, and the forecast goes higher as well. So nationwide demand for BFR is heading rapidly towards 200,000 units a year. Mm-hmm. So this year, even with the companies scrambling to add production, we're only going to serve half of the demand. So there's a huge need for more of this kind of product.
Now, to me, everyone thought people would need more space to live. So naturally, they would go and start looking for more single family houses and townhomes because there's more space. But has that actually taken shape, or is this just, basically the industry expecting that to happen, or is that already started to happen? I always think about, if A happened, then B is going to happen. We know A has happened. Has B already started to happen, where you can actually figure out from data that people are actually moving to larger living spaces as a result of COVID?
Yes, so that is happening. There are, in fact, some builder clients of mine that are building in the BFR space who are only doing 4-bedroom homes. They don't even want to do a 3-bedroom house. So there are people who have families. They have certain days of the week, at least, that they work from home. So they need space for a home office. They need a place for the kids to work remote or to go to school remotely. So all of these things are militating in towards larger houses with more rooms. However, we also see simultaneously growth in demand for small, very small detached homes, and that's where this horizontal multifamily product is coming into play. A lot of very small homes, very close together. You can get fantastic density if you're a developer, 12, 13 units to the acre, and it just makes all kind of sense. And it appeals to your first time, people just forming their households for
Right.
the first
Have
time,
yeah,
millennials and empty nesters as well.
I got that. For the benefit of the audience, and nomenclature is a really, really important thing, I think, especially now that we're early on in this trend. When people talk about build for rent, they kind of use horizontal apartments as a different moniker as build for rent. Do you draw a distinction between, let's say, a single family detached subdivision or a townhome subdivision and a horizontal apartment building? Are there two different product types in your mind?
Yeah, no, absolutely. And I have an exhibit here. I think you're going to show that has 6 different types of built for rent product. And we've done
Okay.
studies on all of these just this year alone. And so yes, there's a different buyer type or renter type. I mean, that needs the single family detached home with a lot of space, a lot of rooms and a yard that's substantial versus those that don't need quite as big of a yard, different family, different age kids, if they have dogs or not, that's a big determinant. But this whole range of built for rent product appeals to people who have dogs. That's a big selling point behind this. A lot, it's a big driver because if you're in an apartment and your dog has to do its business, you got to walk down the hall, go down an elevator, etc.
Yep.
But it's so much easier just to let them out in the backyard or even have a doggy door. So these different types of products all represent differentiation and segmentation, which is going to be very important as more product gets brought to market and there's more competition. It's going to be important to differentiate yourself.
Understand. We're going to go through those different product types in just a second here. I want to go through the rest of these projections you made in 2022, 23, 24, and 25. So this year we're just ramping up, it says, and we're going to ramp up to about 100,000, 110,000 units. Then you have a prediction in 2022 and beyond. You want to kind of go through those different points and why you think that is?
Yeah, sure. So what's really constraining the production of built for rent housing is the land supply. You and I have been to conferences and on webcasts before, and everyone is talking about the same thing. We need more land. We need builders that'll be willing to build for us. And so all of this is kind of the constraint. And so next year, we'll be lucky to hit about 130,000 starts of homes built for rent. So the planning pipeline, as I say, is filling. We're getting more projects planned, more projects starting, but it's still early in the process. By 2023, I think the land pipeline starts to open up. We get more production. We get to around 145,000 starts nationwide just for the built for rent. Then by 2024, we get to 160,000, 180,000 by 2025, and we're still not fulfilling all of the demand.
So these numbers from the 110,000 we're expecting this year all the way through 180, do you have a sense of what portion of the overall new construction housing market that represents? Because right now, from the news articles I'm reading and the data I'm looking at, it's about 5 to 6% of housing starts nationwide.
I think that's understating it. Yeah, I think it's actually already at 7 or 8%. I could see it very easily over the next few years getting to 15%.
Right.
And so yeah, there's so much pent up demand for this kind of product.
What I hear you saying is, right now demand is way outpacing supply. People that are in the business of developing land are not doing it fast enough. That'll catch up, but even when it catches up and gets higher in terms of rate, it's still not going to be enough to speak to all the demand that's out there for
right. And even when we get to the point where 7, 8 years from now we're producing 200,000 homes for rent a year, it's not going to mean like, okay, that's it. Now we start the decline. In fact, I think it just levels off, and the developers just have to get really smart about how to segment, how to differentiate themselves. But I think we've got a couple of years ahead of just not having to worry too much except in maybe a few submarkets in the country where it's head-to-head competition. And I mean, think about it. In the apartment business, you have apartment buildings across the street from one another, and 10 more in a 1 mile radius, or 20, 30 more in a short radius. So there's plenty of space for more. And look at what home prices have done. That's driving more people into renting. Home prices going up at 17% a year, new Case-Shiller numbers. So you have the renters by need, and you also have the renters by choice, which I think is the most important evolution in the rental business that's happened in this whole cycle. People that make $120,000 a year that say, I'd rather rent because it's just more convenient. Somebody else takes care of the maintenance. I'm more footloose. I can move when I want to move. So there's just a lot of factors. And then the millennials starting households, starting families, having children, that's driving a lot of this increased demand for the suburbs. And this is the way we're meeting it.
You mentioned two things that I see. So Strata is a built for rent brokerage, and we're not seeing nuance yet. So like everyone's just out there for a land grab. They want to find things that are middle of the road that come to appeal to everybody. We haven't even started to see, like in large scale, people building, age target communities for rent, demographically centered communities, like active young adult communities. There's so many nuances that haven't even been scratched yet that I'm assuming as we move into 2022 and beyond, when we get to that point where we're at, 15 to 20% of all new construction starts being rentals, I'm assuming it's going to be a really crowded field, and people are going to have to start thinking about how do we differentiate each other from each other, and how do we create more nuance in what demographics that we're really going after as renters,
Yeah.
And
well, it's already evolving. There's already a lot of experimentation going on, a lot of nuance, and a lot of differentiation. And I've done a couple of market studies out of my shop that are for that active adult, age restricted kind of built for rent community. So I think that has its place. That's starting to emerge. But you're right. There's going to be more creativity expressed in the years to come, and more differentiation, more ways to distinguish yourself from somebody else that's doing something similar.
And the other thing you mentioned was builders and people that are in the business of creating lots and building are still figuring this out. So I can't tell you how many small, even large scale builders are figuring out how build for rent can help them increase the volume of land they acquire, that they develop, that they build, because they have a retail business. But the great thing about build for rent is you don't have to build slowly to keep in pace with what you think you can sell retail. Right. You can build as fast as you possibly can, because these things will run out at a much, much, much higher rate than they would sell for. So that velocity that you get in the build for rent segment for a builder is a really interesting business development opportunity, I think. And a lot of builders are just trying to get their hands around that right now.
Well, that's right. If you're a builder, you can get into a relationship real fast where you can sell literally as fast as you can build. In fact, most of the BFR buyers are, demanding more than the builders can possibly produce. So absolutely, that's a definite strategy for builders that want to know for sure what their selling price is going to be once they complete the construction on the units, and what the absorption pace is going to be. And it's going to be well in excess of what you can sell for on the for sale side.
Yeah, and we're seeing that time and time again on my side, builders deciding to get into the space because they figured that the increased volume and velocity that they can actually build homes or even develop lots or develop even land can be much higher if they enter the build for rent space. So let me go to slide number 2 here, where you talk about the different kinds of build for rent. Now, this is super interesting to me because I always think about build for rent as like a single family detached home or a townhome, and those are like the 2 product types that I'm always exposed to. But you've even gone even further to differentiate it into 5 different product types under the build for rent vertical. So can you go through each one and what each asset type really speaks to in terms of a renter base?
Yeah, sure. I mean, so the single family detached home on a full size lot is the most popular, most widely seen, maybe neck and neck with townhomes. But obviously, it's very popular with families. If you have a lot of if you have kids, if you have a dog, if you need a place to work from home, and from the standpoint of density, it could be 4 or 5, 6 units to the acre. suburban townhomes. So this is an attached single-family product, very popular in the suburbs, popular with empty nesters, singles, divorced people, roommates, and couples without kids. Then the horizontal apartments. Some people are catching on that that's not a good marketing name. That's a kind of industry sort of ivory tower name for this kind of product. But they're marketed typically as cottages or some other term like that. But you can get 12 units to the acre, sometimes more. And this combines the advantages of single family living with that of apartments. And better than apartments by far for anybody who has a dog, by the way. That's the big differentiator. Popular with single women, singles, men as well, young families. And then there's the infill, which is more the kind of in the somewhat more urban or close-in suburb area. Small detached. This is another one that I'm seeing more of, where they're going to be a very narrow, skinny house, just getting more density, and it's not allowed by zoning everywhere, but if you can get it, definitely appeals to young families, especially millennials.
They call those zero lot lines. A lot of people call them zero lots. So they almost look like townhomes, but they're single family homes with like almost no space between that house and the house next door, right?
Well, yeah, I mean, zero lot lines, also called patio homes, have been around forever, and you'll see those in a lot of places. And these are even narrower than zero lot line. But yeah, I mean, they tend to be zero lot line, but they're narrower than is typical.
Right. And then the last one is the manufactured homes. And
we've seen some developers saying, look, we're going to build homes, bring them to the site. It's going to look almost exactly like a starter house that was site built, and it's great for the savings that they can pass along to the renters, and they can rent for the same essentially rent as what somebody would pay in a luxury high-end apartment building, and this way they can have a yard and have their own detached unit.
Is there a big cost savings to doing modular and manufactured homes instead of stick built? Stick built,
yeah.
You build it on site versus you build it in a factory and you ship it there.
Huge savings. Yeah, I mean, in the modular for sure, and then manufactured homes, there's a huge savings because I mean that you're going to be able to rent for 25-30% less than
right.
on a site built house, maybe
right.
even more than that.
Got it. Okay, so the next slide here, you kind of talk about the renter choices between SFR and build for rent versus apartments, and there's some overlap, but there's some key differences between what a person gets or what they might want out of SFR and build for rent versus apartments, and where they overlap. You want to go over that for a little bit?
Yeah, sure. So the overlap, I'll start with. They both offer you the ability to, as a renter, be footloose, meaning that, hey, my job moved somewhere else, or I'm going to go over here and live with, closer to family, whatever the reason is, you might want to move around. It's just easier to do if you're a renter. You have the lock and leave convenience. You just lock your front door and go. Somebody else is taking care of the premises. Lower monthly cost than owning. But on the SFR, BFR side, the advantages are more space, more storage, private outdoor space, right in your backyard, basically, more parking. It's better for social distancing, better for working from home, just in terms of the space and just being able to have a dedicated room. And then from the business point of view, you get higher retention. People tend to stay 2, 3, 4 years when they're renting a home, as opposed to an apartment where it's often 1 year. And you get stronger rent growth as well.
It's funny. Another thing that's interesting. I'm talking to a lot of different community builders, and they seem to think that with BFR and SFR, you can foster more of a community feel. In other words, people that might have bought a home but are now renting a home, but they kind of act like it's their neighborhood, right? One firm that comes to mind is Crescent Communities. Crescent Communities is a relatively new player in the space. They got 5 building companies underneath the parent company, and that's their big thing. They want to create a sense of community where you get to know your neighbors so well that the idea of moving out of the rental community is almost like unthinkable unless you really, really want to buy a house. And that is going to end up being or accruing to the benefit of longer retention and the ability to push rents more over time.
Yeah, that's important. And once the clubhouse, if there's a clubhouse in a community, if it's a large enough community to justify a clubhouse, you have just more of a sense of community that develops over time. And when prospective renters come around and they see that there's a liveliness to the area, of vitality, people talking and chatting and hanging out in the common areas and around the pool and so on, that is adds to the desirability and adds to your ability to raise rents. And another thing that comes to mind as you bring that up is that sometimes when people are renting a single family home within a otherwise for sale community, they feel a little bit like outcasts, outsiders. You know, they're
Yep,
looked down
I agree.
upon a little bit by the homeowners. So if it's a community where everybody is renting, then that eliminates that sort of stigma and that feeling of being, viewed as lesser because you're a renter. So that's another consideration.
On the other side of the Venn diagram you have here, you have, apartments.
Mhm.
Apartments, and you draw some distinctions that apartments have that SFR and built for rent doesn't have. You want to just go over that really briefly? I think everyone can understand it like almost intrinsically or like at a high
Mhm.
level, but explaining it might, be valuable from your perspective.
Yeah, so these don't apply in all cases because sometimes the built for rent community these days, they're adding more extensive amenities and being sometimes on par with the
Mhm.
rental apartments. But by and large, on average, a Class A brand new apartment complex is probably going to have more extensive amenities, bigger clubhouse, bigger gym, that type of thing. And for sure, on-site property manager, security, and there's a lot of scalability from the business point of view with apartments. But I think that we're seeing a lot of the BFR developers saying we can do that too, and they're saying we're going to have amenities that are the same as you would find in a Class A apartment building or development, and we're going to have on-site management too. But it all depends on the size of the project. Last year, most of the built for rent projects were just banking on we don't need an amenity per se. The amenity is that it's a detached home.
Right.
And that's the selling proposition. That's all we needed to do. This year, it's starting to evolve where some of the businesses are saying, no, we're gonna go a step above the guys that built last year and provide more amenities, and we're going to do bigger projects in order to be able to scale that way. So if you're building fewer than 100 homes, oftentimes, not all the time, but oftentimes it makes sense to not have a very significant amenity, maybe something passive like tot lot and dog park. But once you get above 150 units, you can start really having some serious amenities.
No doubt. And everyone makes it seem like there's no demographic of people that would love to live in apartments over single family houses. And that's just not true. I know plenty of people who really, really happy living in an apartment. But like from a business standpoint, I feel like apartments are always going to have an edge above built for rent because of the volume and the number of
Oh,
units you
sure.
can fit in a relatively small
Density,
part of
yeah.
land. Right?
Yeah,
It's
density.
vertical.
It's very tempting just to go for the density. Absolutely.
Yeah, yeah, indeed. Okay, so last slide we're going to go over here, and I'll let you kind of intro it. You kind of just talk about the evidence of demand for horizontal multifamily apartments. So the horizontal apartment type of product. You want to kind of go over what
Yeah.
your thought process is here and why you came to the conclusions you did?
Yeah, so the horizontal multifamily concept was really developed by Next Metro out of Phoenix, and then some of the other companies in Phoenix started to do it, and it's really taken hold, and it started to spread eastward. And so, in recent months, we've seen a development. This is an example in Florida that recently leased up, and the concept, of course, is you take essentially what would be a single plat of land and you're building detached homes on it or duplex homes on that parcel, and they're very close together. You can do that because it's that single plat that's more of a multifamily piece of land essentially. And so you can get this fantastic 12 to the acre density, and it just makes the economics of the project work very well. You can offer small detached homes, 1 bedroom, 2 bedroom, 3 bedroom, and there is a clear audience for that. In fact, there's several different audiences, and it depends. It's different in Phoenix versus Florida as to who it is that's going to be the renter profile for that development. But it appeals to a very broad audience. It keeps the rental costs low while still offering the tenant their own private outdoor space in the backyard for the young kid or a dog. And sometimes they're installing pet grass and a fence in the back, anticipating
Right.
that there's going to be a large number of people with dogs. So it's just a really powerful innovation that has emerged in this segment. And I see it increasing very dramatically as a share of all the built for rent development over the next few years.
Yeah, it's funny. I kind of look at this as a broker that's out there trying to find projects for buyers that are telling me they want X, Y, and Z. And it's easy enough to find a piece of raw land that is zoned, for density enough to build either townhomes or single family detached. But like when you get into these more nuanced, different kind of product types, it almost belies the idea that a builder has to have a key knowledge on how to rezone land and take it through any kind of rezoning and reordinancing that needs to be required to build that different kind of product type. I think that's probably the hardest part as a person that's out there trying to find deals. How do you find the right piece of land that the city is going to be okay with you building this relatively new and like
That's the key.
unproven
That's the key.
kind of product type, right? So it's always a big like problem for me where I'd love to find, a 5 acre parcel of land that you can put, 12 units to the acre, but like the chances of a town being okay with that kind of density, it's going to take a guy that was a lot more charming than me to convince the townspeople that this is the right move for the community.
No, for sure. That's probably the number one obstacle to this type of development is the local municipalities look at it and they say, what is
You
this?
don't
Is it
understand it.
single
Yeah,
family? Is it multifamily? How do I classify this? And that's why it's confusing when people look at the census numbers on how many built for rent homes there are. There's a great deal of confusion and uncertainty over that. And, I suspect that the Census Bureau is relying on these local clerks at the cities
agreed.
and
Yeah.
municipalities to report. And I suspect that a lot of times they don't even know how to report it. But I think it's an educational process. I think that they will catch on. They'll realize that this is a viable type of product and it's good for their city. And I think that's going to start to catch on. It's
Yeah, I
just
can imagine
we're in
that
the early stages.
they can't. It's neither fowl nor fish. So like they don't even realize
Right.
there's another category out there called steak, right? And this is that,
Yeah.
and they haven't figured out how to classify it. But everything is going to get
Yeah.
better as we move along and as more of these things get built. So you gave an example of a horizontal multifamily test case in Florida, right? So you want to kind of explain what you did here and how you built this case study?
Yeah, sure. And this slide is actually taken out of an actual study that we did for somebody that was developing a horizontal multifamily development in another part of Florida, but just to kind of show, hey, here's the test case that shows that it works, that the market will accept it, and they'll pay top dollar for it. I mean, these rents came in at multifamily kinds of rents, $1.80 to $2.10 a square foot. We found that on a per square foot basis, the rents can be 20 to 25% higher than a lot of the area apartments, including some that were part of this Lakewood Ranch Master Plan community. So, you look at the test cases out in Phoenix, these horizontal multifamily developments have just knocked it out of the park and they've raised the rents by 7, 8, sometimes 10 or 11% in a year.
Right. And you're talking about this specific subvertical of built for rent. Does this go for like single family detached, townhomes, infill suburban? Should we generalize it to all of the different asset verticals underneath built for rent, or is this only for horizontal multifamily?
So what I'm talking about right now is specifically horizontal multifamily, where it's a single plat, and then they develop 1 and 2 bedroom, 3 bedroom, sometimes depending on the mix they want, houses that are very small. I mean, a lot of the houses are, 700 square feet, like for a 1 bedroom, 1 bath detached home. 1,000
Big
square
house.
feet for a
Yeah.
two bedroom house. So, and those are renting for $1,500, $1,800 a month.
Right.
So it's really different. It's completely different from townhouses. It's completely different from, zero lot line patio homes. So I view each of those product types as being different, and for a different purpose and a different audience.
Got it. And you talk a little bit about single family rent trends. In this case study in Tampa, Florida, and the Tampa MSA, and specifically Pasco County, this slide goes over SFR rent growth in Tampa MSA
Mhm.
and in Pasco County versus like single family homes in the same area. And you kind of draw a
Mhm.
comparison between the two.
Well, so sort of. This is actually another page that was taken out of one of our actual site-specific studies, happened to be in Pasco County. And so what I'm showing here is simply the trend, and you can apply this to a lot of markets around the country. So what this shows is the rent growth on a per square foot basis, uh, for the metropolitan area as a whole and for Pasco County in particular. And so you're looking at 6% rent growth on an annual basis that's going on this year. And then it just shows the differential between the MSA and the county. You can look around the country and you'll see some of the secondary markets, Savannah and Augusta, where we're doing studies and we're finding that the rents have been going up at 7 or 8% a year. And you go out to Phoenix and they've been going up 11 or 12% over the last 12 months. And it's just incredibly strong. I think that, over the next few years, 2022, 2023, it'll start to kind of taper off a little bit, but you'll still see rent growth that's quite strong. And it'll probably start to merge back to the rate of growth of rental apartments at a point. But for right now, it's growing faster than apartments.
Right. Curious. I mean, rent growth can only stay this strong for so long until it hits a plateau, right? And there has to be an
Correct.
inflection point. Like there has to be an inflection point where it can't keep growing by like 7, 8, 9, 10% a year.
Correct.
Why do you think it has so much room to grow right now? And what do you think that inflection point is going to be when it ultimately ends up plateauing to a normal rent growth rate of say 2 to 3% a year?
Yeah. So there's a couple things that are going on. Number one, because this is an experiment, this is a new product type, especially when they come into a new market and say, we're going to do this kind of product here. There's discovery going on. And how much can we charge for the, especially if it's the horizontal multifamily or even some of the, narrow profile detached homes. So they've often hit the market too low. And that's partly why the rents have been going up so fast. But so I think that is part of why we start to see a moderation in the next few years. Also, just affordability. There's only so much blood you can squeeze out of a stone, right? So you'll start to see it kind of come back more in line with income growth, but there's still such a shortage of supply relative to the demand. That's why people are finding a way, and they're paying more for rent and sometimes taking on roommates or what have you. And that's partly why the rents have been able to grow so much faster than incomes in the last few years.
Got it. And in terms of like where you think it's going to plateau, is it when the price of a home, the price that someone could build a rental property for is going to get to be a little bit higher than what someone can actually afford to buy it for, and the rents can only go so high and make those numbers make sense? Is that
Well,
what you think is going to happen, or?
yeah, to a degree. I mean, there's still some room to run just from the standpoint of it's still more affordable to rent than to own in most cases, most markets, especially when we do a market study too. We like to compare what is the cost of renting one of these units to the cost of owning a home. Not that renter is necessarily even considering buying. They're probably just either a renter or a buyer and not kind of on the fence, although there are some. But you still have to make that comparison. And what you find is when you take into account not just the PITI and the HOA fees and CDD fees, but you also, in the ownership column, you add in the cost of maintenance.
Yep.
Okay, you add that in, you based on a rule of thumb that we use, then, in most cases, we're finding that it is less expensive to rent from our client's development than to own a house. So there is still that delta that we can play with a little bit. But sooner or later, I think we get back to more of the 4-3% kinds of rent increases, because again, there was a little bit of trepidation in recent years. We're starting out. We're not sure we can get rents that are at $1.30 a square foot. Maybe we're going to come in at $1.10. But then, Next Metro showed an example where they started out at $1.30 a square foot, and by the end of the development, they were at $1.75 a square foot. So that's partly what's been going on. But I think that now people are starting to catch on to where, how to triangulate, and we're helping them. We're doing these studies, and we always triangulate, or sometimes they say, quadrangulate or pentangulate, using all the different data that we can dredge up in the market, looking at rental apartments, looking at SFR, shadow supply, looking at the cost of ownership, units that are owned by the big platforms like American Homes for Rent and Progress, and you triangulate and figure out what the rents can be. And I think that now they're catching the wave better and not leaving as much money on the table.
Yep. All good insight. And we're going to end up here on a slide where you go over the evolution of the build for rent niche, which to me is kind of like a story of my career over the last 10 years, right? So for people who haven't experienced it the way I have or the way you have, this slide goes over like what the first firms were to actually take hold of this asset class to make a business out of it, and where that kind of led to up until 2021. You want to kind of give us just a brief overview before we
sure.
Get out of here?
Absolutely. It's pretty self-explanatory. Around 2009, 2010, a lot of companies were just buying SFR and just buying the units, renting them out, buying them out of foreclosure, et cetera. That got a lot of publicity, and then companies started saying, "Well, let's actually build some new product, because it's getting more competitive. The prices have gone up after 2013, 2014. So more companies started piling in to building for rent. And I have Lennar on there. They were really just sort of selling off a little section of a subdivision here and there, not really kind of fully all into the built for rent business like they're getting into it right now. And then you had entrants by 2018, Tricon, Watermark Equity Group, and then last year we started to see Clean Living Communities, and some of these big companies are starting to really pile in now. So as you say, kind of joking, BFR is a BFD now. Lennar formed its Upward America venture to buy more than $4 billion worth of single family and townhomes built by Lennar and other builders. My estimate of their build, I think that's going to end up about 13,000 homes. They formed Lennar SFR earlier this year to manage that venture. And of course, you have Toll with BB Living. Their first project is open now, Las Casas at Windrose. And plus, they have 20 more neighborhoods that are planned for built for rent in Texas, Florida, Utah. D.R. Horton under DHI Residential, their first project is in Charlotte. So it's just starting to build a great deal of momentum now. And I think that momentum is just going to be sustained, as I show in my forecast that we already went through about, for the next 5 years and then beyond. We've got at least a good 10-year run coming up.
Brad, I can't thank you enough for spending time with me today. This is super interesting. And we'll do it again.
Thank you, Adam. It's really a pleasure to talk to you, because you have the same level of enthusiasm over this segment that I do. And I really appreciate you having me on.
Thanks a lot.